Here. Let's bring in our first guest for the hour. We've got Joe Duran. He's Goldman Sachs head of personal financial management. Joe, it's good to talk to you. You've been listening to our conversation here, sort of trying to dissect this $1.9 trillion plan. I just cited this number from Goldman Sachs saying it's going to be closer to 1.1 trillion. How are you looking at this sort of line by line as we look at the headline of $1.9 trillion potentially in stimulus coming?
Well, the stimulus is great, but it's a temporary solve, and we will need more of them if we don't get this pandemic under control. Remember, all of these are the Band-Aids. The disease is still there. And so the recovery is really completely linked to how quickly everyone has comfort to go back to work in a modified way. But we actually feel quite optimistic that while we have new strains of the virus that we are unsure that everything we're doing is effective against, and there will be setbacks to the rollout, that by the second half of the year, we're in very good shape. And in fact, we think the US will actually be the only developed country to have a run rate GDP in the fourth quarter in 2021 that is greater than it was at the fourth quarter of 2019. And so that suggests that if you're going to be invested, the U.S. is the place to be. We are recovering quicker. We're also more adept as an economy. And that doesn't mean it's going to be smooth sailing. Certainly the market is reasonably fully priced here. And I think maybe a little bit optimistic about the speed of the pandemic getting under control. But with all of these things, remember, the market anticipates recovery. I think we're at the point now where we're hitting a tipping point. And once we get to 100 million vaccinations, we don't need to get there. We just need to be on pace to get there for people to start feeling comfortable again going out and for states to loosen up and start being okay. So I think it's all inextricably tied together. And yes, it matters. The stimulus package is needed and necessary. Certainly anyone who lives and drives by their local restaurant can see that. But what we're seeing is big companies are doing quite well. And so I think it's frustrating for some to see how well the stock market is doing when they see how poorly their local economy is doing.
Yeah, and Joe, when we talk about some of those risks, let's bring in the known unknowns and the known unknowns, or you know what I'm trying to say here, the known unknowns and the ones that we don't know. When we talk about it, it seems like the push here to pay for vaccines and distributing those to Americans, we already know the issues that are there in terms of distribution. The unknown here, I think, might be the idea that Americans don't necessarily want to get that. That's the big question of how many Americans are going to get it once we move past kind of this older than age 65 population and you start to get into younger Americans. When you think about the timeline there, it seems like we've heard so much about the summer returning to normal, perhaps by the fall. When we listen to Dr. Fauci here, the expectations there seem to be the swing factor that could start to see maybe valuations that, as you said, are trading at pricing imperfection here. What do you see as that being the swing factor, maybe to the downside?
I know we're all talking about herd immunity, but for the stock market and for the economy, the herd immunity point is not the point at which we're going to be fine. It's actually quite a lot sooner than that. It's when we can see that there's a herd immunity point that's going to occur and we're going to completely reopen back to normal. I will say, most firms are adapting to this new world on the assumption there will be more of these. And so, I think even with this shutdown, it's not quite the same as the last shutdown. The sense of panic and rush for toilet paper, that's not there anymore. And so I think what you'll find is that initial shock, we won't experience that again. But there might be, as we've seen, there's two new variants. We don't know how the vaccine works against those two variants. So those are the unknowns that we don't know about. How will we do? Now, the reality is we have to get back to working. We have to get back to opening restaurants. And so the point at which we have enough immunity that anyone who feels vulnerable can take care of themselves, that's the point at which you will see a much stronger economy and therefore a stock market and everything else, GDP growth. So I agree with Kiko's comments earlier on. We appear to have hit a little bit of a soft patch. Look at the unemployment claims earlier on this year, and it appears that things are getting a little bit stuck. That's not unexpected. And I think what you'll see is it'll be a little bit of a a rocky road to recovery. I think by March, we're already starting to see, wow, my mom and my stepdad and my uncle, they've all gotten the shot. They're all good. And I don't need to worry about going and visiting them anymore. Those are the things that will loosen things up. So it's not going to be all of a sudden tomorrow, everything's good. It's going to be this gradual coming back to normal thing that occurs over the spring. And hopefully by the summer, we're back to something that resembles somewhat what we had before. Now, again, I don't know that people go back to the same work. I don't know that they travel quite the same way, but something that resembles something more normal.
Yeah, I mean, Joe, you could argue to a certain extent some of that optimism has already seeped through into the market. Even if some investors haven't gotten their vaccines, they've seen their parents, for example, at least get an appointment to get a vaccine. And that's, if anything, light at the end of the tunnel. When you talk about looking for where companies see the bounce back, we've obviously got the big banks reporting today, but this kind of kicks off the cycle of earnings season. What are some of the numbers you're going to be looking to that maybe suggests a timeline that the companies see? If you look at the banks, for example, today, releasing some of the reserves they put on hold for what they were expecting, a much more significant loan loss. Is that a sign that potentially 6 months down the line, there is sort of a better picture, at least for the banks?
Around the banks, I kind of have to avoid things. As you know, we report in next week, so I kind of can't touch bank earnings. I can say that what we are seeing actually is that when you look at the companies that are comfortable working digitally native, their earnings have been fine. The areas that, of course, we still don't see recovery yet are travel, some real estate operators. But even we're already, I think, have seen the trough in all of their situations. So I think, I'm very encouraged by what we've seen in small caps so far this year. They've really led the market. And that suggests that the Biden administration, what they're going to do will help small companies. That eventually, of course, trickles up to big companies. But they are the ones who've been hit the hardest because they're the ones who have the least in technology spend, the least adaptability. And so large firms have been quite robust. Business is being conducted, and I think most businesses, larger firms, are able to continue this way for quite a long time. And so again, it's the small business that requires a visitor in person to have the experience that's being hurt. The nail salons, the restaurants, the massage folks, like the people who are delivering spa services, all of those haircuts, those things that you have to be in person. There's very few large businesses that operate that way. They're the ones that are being harmed the most, and obviously the folks who provide them services. And so I think that's going to get much better in the next few months. And I think a lot of governors are looking to open up again, because as the governor of New York said, it won't be an economy if we don't open the economy.
Yeah, no, it's very true. And it's a sentiment that gets stressed here, particularly by those hardest hit sectors. Joe Duran, Goldman Sachs, head of personal financial management. Appreciate you joining us here again today. Be well.